Hello everyone, warm welcome to Super Coaching Regulatory Bodies YouTube channel by Testbook. So I welcome you all in a very important session. We call it as marathon session because today we will be discussing 100 questions, that is the 100 MCQs based on your finance, and along with that we will be discussing some of the descriptive questions which are expected in your examination, some of the descriptive questions as well which are expected in your examination. So before we start the discussion, I would request everyone do reply in the comment section that I am audible, visible, everything is fine, we are good to go, so that we can begin the discussion without any further delay. And I can assure you guys, after watching this particular session, you will be in a position to answer most of the questions in your examination from the finance section. So let's begin the discussion without any further delay. Let's go with the first question of the evening, and the first question is now on your screen. The question says, which of the following statement is or are correct with respect to Basel Committee on Banking Supervision? First is, it was established in 1974. Okay. It has 45 members comprising central bank and bank supervisors from 28 jurisdictions. Okay. Its decisions do not have legal force. Now, we all know that BIS, that is Bank for International Settlement, has its headquarters in Basel, and BIS has set up a committee, that is Basel Committee on Banking Supervision, which is framing the rules and regulations in order to achieve, we can say, in order to achieve similarities as well as uniformity in the banking sector all around the globe. So BCBS was set up at the time of failure of Bretton Woods Agreement. So according to this, it was established in 1974. Is it correct? So that is absolutely correct. It has 45 members comprising central banks. That is also correct. And if I talk about its decision, yes sir, its decisions are not legally binded, which means if a central bank follows the decision, it's fine, and if central bank do not wants to follow, then also it's okay. There is no legal bindation, or there is no legal foundation to follow these rules and regulations. So the answer to this particular question, so all the statements, that is 1, 2 and 3, are absolutely correct. So answer is going to be D option. Moving on to the next question. What does the next question says? Which of the following is the bank's core capital, equity, and the disclosed reserves that appear on the bank's financial statement? We know this very well, that whenever we talk about capital in as per Basel 3 is categorized as tier 1 capital, additional tier 1 capital, and tier 2 capital. But the core capital, which include the equity as well as disclosed reserves, that is obviously tier 1 capital. So tier 1 capital includes the bank's core capital, equity, as well as the disclosed reserves. So answer to this particular question is going to be what? That is tier 1 capital. That is absolutely correct. Moving on to the next question. Which of the bank's supplementary capital? So primary capital is tier 1 capital. Supplementary capital, which comprises of undisclosed reserves as well as subordinated term deposits, these types of capitals are included under which category? So it is included under tier 2 category. That is, it is included under tier 2 capital. So according to this, the answer to this particular statement is going to be B option. Tier 2 capital is absolutely correct. Remember that tier 2 capital includes what all things? So it includes undisclosed reserves, it includes subordinate term debts, as well as financial product. What type of financial product? That is hybrid financial product, which means which has a characteristics of equity as well as of debt. Then items that must have an original maturity of at least 5 years, they are included under the tier 2 capital. So tier 2 capital is less reliable than tier 1 capital, because tier 1 capital includes the core capital, and the core capital is most reliable in terms of handling the loss, or I would say the first point or the first wall against loss for a bank is which capital? Then your answer should be tier 1 capital. Moving on to the next question. Which of the following statement is or are correct with respect to liquidity coverage ratio? So we know that liquidity coverage ratio is a term which was introduced in Basel III, and in Basel III, liquidity coverage ratio was introduced. Liquidity coverage ratio was introduced, and it was introduced in Pillar 1 itself, where we talk about the capital requirement. What does liquidity coverage ratio says? So liquidity coverage ratio should be greater than or at least equals to 100%. But what is liquidity coverage ratio? So liquidity coverage ratio is basically high quality asset. It is basically high quality asset, upon upon net cash outflow in 30 days. What does it basically means? Let's try to understand this point. So liquidity coverage ratio basically means Harsha, you have got your UGC result, I guess. Harsha, may I have a reply? Okay, so then I'm not sure that whether you have commented, why you have given this thanking note to me. May I know that? Okay, good, 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 fine, fine. Congratulations, Harsha. Congratulations. Chalo. I hope you have joined with me on my Telegram. Do share your message on Telegram so that I can discuss more on the same. Okay, chalo. Let's continue the discussion. Okay, so the question we have is, liquidity coverage ratio. So liquidity coverage ratio means the bank should hold high quality liquid assets which can be converted into cash easily, and that should be in a ratio to net cash outflow during a stress period. That means if there is a stress scenario and in next 30 days, what is the actual net cash outflow a bank is going to visit, that value has been written. So basically what I'm trying to say is, I'm trying to say this: in case of liquidity coverage ratio, bank has been asked to maintain high quality liquid asset which should be capable enough to service net cash outflow in 30 days in the stress period. So that is known as liquidity coverage ratio. So it requires banks to hold sufficient highly liquid assets. This is true. It was introduced as a part of Basel III reform. That is true. It promotes long-term resilience of banks to potential liquidity disruptions. It promotes long-term resilience or short-term resilience. Can you give me the answer? It promotes short-term resilience or long-term resilience. What should be your answer for this particular point? I'm pretty sure if you are aware of this particular concept, then you will be in a position to answer this particular question. So do answer this question in the comment section, please. What should be your answer? Sir, is it long-term or short-term? What will be your answer? So the answer to this particular question is, whenever we talk about liquidity coverage ratio, it basically focuses on what, sir? It basically focuses on your liquidity requirement for servicing the short-term day-to-day operation. So in that particular case, third statement is incorrect. First and second statement is correct. So the answer to this particular question is going to be A option. Moving to the next question. Which of the following statement is or are correct with respect to the net stable funding ratio? Again, net stable funding ratio was introduced in Basel III, and net stable funding ratio is also asked to be maintained at a value greater than or equals to 100%. But net stable funding ratio is basically available stable funds upon required stable funds. It should be greater than or equals to 100%. But the question is, what is this required stable funds? So required stable funds basically means the funds, or I would say it basically means the funds required by the bank which is going to be serviced in next 1 year. Which means if you are, as a bank, if you are supposed to pay interest, or if you are supposed to pay or repayment of the loan which is going to be done in next 1 year, that is known as the required stable fund. Bank should hold the stable funds that should be greater than or equal to the requirement of the stable funds. So it requires banks to maintain a stable funding profile to meet medium-term requirements. Yes, it is basically 1 year term requirement. So on the basis of 1 year term requirement, first statement is correct. It was introduced in Basel II. No, sir, it was not introduced in Basel II. It was introduced in Basel III. Then the question is minimum net stable funding ratio is 80%. No, sir, minimum net stable funding ratio is not 80%. It is 100% as it is clearly mentioned. So accordingly, answer to this particular question is only one, that is A option. Sorry, first option is correct. So I'll go with which option out of the given? That is the D option. Moving on to the next question. Which of the following risks are covered under Basel II norms? Which of the following risks are covered under Basel II norm? What will be your answer? So Basel II norm talks about market risk, credit risk, operational risk. So first of all, so credit risk is not only discussed or targeted in Basel II, rather it was targeted in Basel I itself, then it was targeted in Basel II obviously, then in Basel III as well. But if I talk about the other market risk, this was introduced in Basel II. Operational risk was also targeted in Basel II. They were not targeted in Basel I. So accordingly, under Basel II, all these three risks were targeted and banks were asked to maintain the desired or required reserves in order to counter these risks. Moving on to the next question. Basel III Accord raised minimum capital requirement for banks from dash in Basel II to dash of common equity. That means in case of common equity, out of the common equity, what percentage is going to be maintained? Earlier, while Basel II, it says 2% should be maintained out of common equity, but now it has been increased to 4.5%. So the answer to this particular question is going to be B option. So this is a very important aspect which you need to remember. Direct question can be asked in your upcoming examination. Moving on to the next. Which of the following is not among the three important pillars of Basel III? So Basel III has three pillars, or I would say for that matter, Basel II also has three pillars. This is pillar 1, minimum capital requirement. Pillar 2, supervisory review process. Pillar 3 is your market discipline. Credit risk is not a pillar, rather it is a risk which has been targeted under the Basel norms. Even I would say in Basel I itself, this risk has been targeted and this risk has been looked upon, or I would say it has been tried by the Basel norms to counter this risk from its first norms itself. So pillar 1, pillar 2, pillar 3 are mentioned. D option is going to be the correct answer. Moving on to the next question. So Basel Committee on Banking Supervision has set the minimum requirement for leverage ratio at. First of all, if someone asks you, so what is leverage ratio? What will be your answer? See, the moment we say leverage ratio, it is basically capital measure It is basically capital measure upon capital measure upon it is basically capital measure upon exposure measure. Obviously, leverage ratio is measured in different forms, but the leverage ratio which we are referring over here is this is capital measure upon exposure measure. And as per Basel norm, it should be greater than or equals to 3%. So according to Basel norm, it has been fixed as 3%, but RBI has fixed it as 3.5% for all the banks, but domestic systematically important banks, this has been fixed as 4%. So you need to remember this data as well, because direct question can be asked on this part as well in your examination. Moving on to the next question. Which of the following situation occurs when many customers of a bank or other financial institutions withdraw their deposits simultaneously over the concern of bank solvency? So if many of the bank customers, they are afraid and they feel that bank is going to or I would say bank is in a tough situation, bank in near future may not be able to service our withdrawals, so they pre-decide to withdraw all their deposits. If they're withdrawing all their deposit, it will lead to what? So it will lead to liquidity crisis. It will lead to liquidity crisis, and when bank is under liquidity crisis, that means bank is not in a position to service your withdrawals. That means bank do not possess the funds to pay or to service your withdrawals. That means you are standing in front of ATM and you are typing 10,000 rupees and it says, we are really very sorry, we know you have account balance above 10,000, but SBI is not having the funds to pay your 10,000. That is the situation I'm talking about, and that situation is termed as what? It is termed as bank run, when bank is not in a position to pay or to service your withdrawal demand due to lack of funds. That situation is known as what? So it is known as bank run situation. So C option is going to be the correct answer. Moving on to the next question. Indian government bond yields are influenced. I guess I have missed the numbering. So no worries. Next, this is 11th question we have. I have 100 questions for you. Indian government bond yields are influenced by which of the following factors? So whenever you purchase government bonds, you are going to receive the interest rate against the principal which you have deposited or the principal against which you have purchased the bonds. Now, the question over here is, when this is a situation, bond yield depends on which all factors? My answer would be, sir, bond yield depends on inflation. Obviously, whenever there is change in inflation, for example, if inflation increases, and due to increase in inflation, interest rate in the market changes. Let's suppose interest rate decreases. So if the market interest rate is decreasing, then bond price will change. And if the bond price is changing, then it's quite obvious yield is going to change. So obviously yield depends on inflation, that is for sure. Moving on to the next point. Sir, bond yield depends on actions of RBI. Yes, obviously RBI is the regulator of banking sector. RBI is responsible for maintaining the financial and monetary stability. So if RBI comes up with a norm, that norm will impact the economic situation of a nation, and that economic situation of a nation will hamper, or it may support, it may increase or decrease the demand on these bonds, and if the demand changes, price of these bonds will obviously change. So answer is going to be B option, that is correct. Action of US Federal Reserve. For example, the US Central Bank, it increases its deposit rates, then obviously the one who has invested in India, they will be disinvesting their funds and they will be investing back in US in order to earn high returns. So those individuals who have purchased, government bonds in India, but they know that now they can earn more return by investing in US, obviously they will be investing in US rather than investing in India. So in that case, bond price will change and bond yield will change. So answer is going to be 1, 2 and 3. All of the statements are correct. Moving on to the 12th question. If I talk about the 12th question, which of the following statement is or are correct with respect to the stock exchange? If you're talking about stock exchange, that is financial institute or financial institution which is operating in the capital market, which is responsible, or I would say it's a platform which allows buyers and sellers to sell and purchase the shares. That particular platform where the price of the share is decided on the basis of demand, supply, as well as the company status, that is known as stock exchange, which is registered under SEBI. It is exchange where stock brokers and traders, they can buy and sell security. That is true. Second, securities traded on stock exchange can include stock issued by listed companies. Securities traded on a stock exchange can include only securities traded by listed companies. That is also true. Anyone can trade? No, sir. Anyone cannot trade. You need to fulfill the criteria which is set by SEBI. You need to get yourself registered, and there are a number of other, I would say, limitations which you need to fulfill. And once you fulfill those limitations, then only you can trade on stock exchange. So answer is going to be 1 and 2. Moving on to the 13th question. Which of the following statement is or are correct with respect to the over-the-counter market? Over-the-counter market is basically a place where the trading of instruments is done. I would say, over the counter basically means I want to sell the share and you want to purchase it. We are making the trade by standing in front of each other. That is known as over the counter. So over the counter, it is a decentralized market in which participants trade stocks directly between two parties without, yes sir, you and me, we are directly trading or we are directly making the transaction. No third party is involved. They do not have physical location. Yes sir. Wherever you are exchanging the instrument, that is over the counter market. So there is no physical location fixed. They are more transparent in comparison to stock exchange. No sir. How they can be transparent if there is no third party involved? The point of transparency cannot be discussed. The point of transparency cannot be discussed, and if the point of transparency cannot be discussed, it cannot be mentioned over here. So answer is going to be 1 and 2 only. C option is the correct answer. Moving on to the next question, that is the 14th question, I would say. Which of the following statement is or are correct with respect to equity? It is the amount of capital invested or owned by the owner of a company. Okay. It does not take intangible assets into account. Okay. Stocks and equities are synonyms as they both represent ownership in an equity and are traded on stock exchanges. So remember one thing, whenever we talk about equity, so equity is basically related to the term when we subtract liabilities from asset, the left out amount is known as equity. Equity includes the amount capital invested or owned by owners of the company. This is true. It does not take intangible asset. Yes, sir. It does not include the intangible asset. It only includes, or it only take into account the tangible assets. So intangible assets are not included. That is correct. That means if I say intangible asset such as your reputation, intangible assets such as the brand name, these are not included. So that is incorrect. They are included or not included. It does not include. Sorry. I think I read that it include. So it does not take, sir. Sorry. It takes into account. It does take intangible assets into account. So second statement is incorrect. Stocks and equities, they are synonyms. That is true. So answer is going to be 1 and 3 only, because intangible assets, they are included as a part of equity, but here it is written they are not included. So that will be wrong. So second statement is wrong. Rest 2 are correct. 1 and 3 is the correct answer. Moving to the next. Which of the following statement is or are correct with respect to the stockbroker? Which of the following statement is or are correct with respect to the stockbroker? So if you talk about stockbroker, any person who is registered with SEBI, Stockbroker and Subbroker Rule 1992, he or she is also a member of stock exchange. Okay, they buy, sell and deal in securities on the behalf of the investors. So stockbrokers, it could be a person which is registered. He or she is a member of stock exchange. That is true. When you open up a trading account, that trading account you generally open up with a stock exchange only, which allows you. You open up a trading account with the stockbroker only, which allows you to make the exchange on different stock exchanges. Basically, broker is making a trade on your behalf. So that is correct. So answer is going to be A, B, C. All the 3 are correct. That is absolutely correct answer. Moving on to the next question. So next is your 16th question. Who is responsible for keeping as well as safeguarding the investment and securities on the behalf of owners? So whenever you keep and safeguard your securities with the party, that is basically known as what? The party which holds your security, keeps it safe, is known as custodian. So answer is going to be A option. That is absolutely correct. Moving on to the next question. That is 17th question. It is a customized contract between two parties to buy or sell an asset, product or commodity at a predetermined price later. So forward is a contract. That is true. They are not traded on centralized exchange. Yes, sir, because when they are traded on centralized exchange, they are known as future. They come under categorization of derivatives. That is also true. So answer is going to be B option is absolutely correct for forwards, because forwards are what? So they are customized contracts. That means two parties which are involved, they can customize the contract the way they want to in order to buy or sell an asset or a product or a commodity at a predetermined price. A option is correct. B option is incorrect because it is not traded on a centralized exchange. It is basically over the counter contract has been signed. And third is they come under the categorization of derivatives. That is true. So B option, 1, 2 and 3. Achha. Sorry, they are not traded on stock exchange. That is true, sir. I read it, they are traded on centralized exchange, but they have mentioned they are not traded. Yes, according to this, C option is correct. I'm really very sorry. I just missed the term not, because of which I mentioned the answer B, but it should be C because they have clearly mentioned not. They have clearly mentioned not traded on the stock exchange. Moving ahead. 18th question. Which of the following offers the right to purchase underlying securities at specified price within a specified time frame? See, we know that derivatives are basically the financial instruments which do not possess any value. Rather, their value is taken up from the underlying asset for which basically that derivative or that contract is signed. We know that. Now, we have different types of derivatives. One, we have forward, future, then we have option. As the name suggests, option derivative gives you an option whether to buy or to sell. Now, what we have, sir, which of the following offers the right to purchase underlying security? You have a right that whether you want to purchase it or not, it's your call. You want to purchase it or not, but yes, you have a right to purchase. That is known as call option. When you have a right to purchase, that is known as call option. So call option offers you the right to purchase underlying security at a specific price within a specified time frame. The strike price is a term used. Strike price means the price or the amount you pay. Expiration date is the deadline for exercising your option. That is a call option. Moving to the second one. Sir, now you have a right to sell. It's up to you whether you will be selling on the pre-decided price before the pre-decided date, or on or before the pre-decided date or not, but yes, you have right that you can sell. No one can stop you no one can stop you to sell that security. That is known as what? So that is known as put option. So remember strike price, expiration date, along with that remember put option and call option. These two are important. Moving on to the 20th question of the evening. What does the 20th question says? Which of the following are the derivative financial contract obligating the buyer to purchase an asset or seller to sell an asset at a predetermined date? So predetermined date, which of the following derivative financial contract obligating the buyer to purchase an asset or seller to sell an asset? Buyer to buy an asset, seller to sell an asset. That is basically termed as what? Sir, is it termed as forward or future? See, when nothing is clear, we will consider that they are talking about an instrument. We will consider that they are talking about an instrument which is going to be traded on a centralized exchange. So answer is going to be A option. I'll go with future over forward. So A option will be the preferred answer out of the two. Moving on to next. Moving on to the 21st question. What does the 21st question says? Which of the following statement is or are correct with respect to the debentures? What are debentures? So debentures are the debt instruments which are basically used to borrow the funds. But debentures are generally issued by government. Why? It is a type of debt instrument that is not backed by any collateral. That is true. Only government bonds, or I would say only government can issue debentures to raise capital or funds. That is true. Sir, is it short term? No. Bill is short term. Debenture and bond, they are long term. So C option is incorrect. I'll go with A and B. So according to this, D option is going to be the correct answer. Absolutely correct. Moving on to the next question. Which of the following are the financial contract in which the buyer or seller has the right but not the obligation to buy or sell a security or a financial asset? This is very important and an easy question. What does it say? It says what type of derivative has been mentioned on the screen, which says that we give right to buy or sell, but you are not obligated to buy or sell. It's your choice. You have a right. No one can stop you in buying or selling, but no one can force you that you should buy or sell. So that is basically termed as what? So that derivative or that type of derivative is known as what? It is termed as option contract. It is termed as what? Sir, it is termed as option contract. Is it clear, everyone? Is it clear, everyone? Do give me yes, sir, in the comment section, please. Okay, moving on to the next question. The next question says, please pay attention. This is the 23rd question. I'm sorry for the numbering. I think I made some mistake. No worries, leave it. Which of the following statement is or are incorrect with respect to the financial instruments? Preference shares can be redeemed, but one cannot redeem equity share. That is true. You can redeem the preference share. Obviously, there are non-redeemable preference share as well, which are available in the market, but you can obviously redeem the preference shares. Preference shareholders cannot have voting rights in general. That is also true. Government securities are debt instruments issued by RBI. So government securities are bonds, or government security bonds are the debt instruments issued by RBI on the behalf of government. That is true. So answer is going to be A, B and C. That is E option is correct. Moving on to the 24th question of the evening. Which type of preference share provides the right to dividend for a particular year cannot be carried forward to the subsequent years? What does it mean? It means, let's say a preference share has been issued, and preference share has been issued at a return of 10%. In the first financial year, company has recorded a profit of 20%. Preference shareholder will get 10% profit. In second financial year, if company has recorded a profit of just 2%, preference shareholder will receive 2% only. In the third financial year, if company is now doing well again, 30% profit is recorded and preference shareholder will again receive 10% only, because you have been issued, or the preference shares have been issued at 10% only, which means the left out promised 8% profit will not be carried to the next year. That is basically termed as non-cumulative preference share. But on the other side, cumulative preference share basically means this time company will be paying profit or sharing profit equal to its profit or equal to the promised dividend. So if promised dividend is higher than the actual profit, so you will be getting 2% only. But in the next year, if your profit is higher than the promised dividend, so company will pay whatever is promised, that is 10%, but company will also pay the left out profit, which was not shared, not paid when company was not earning profits. So that kind of preference share where your left out profit is carried forward for the next year, that is cumulative share. When it is not carried forward, that is known as what? So that is known as non-cumulative. That is known as non-cumulative preference share. Moving on to the next question. So the next is the 25th question of the evening. What does this question says? Let's check it out. Which type of preference share gives holder the right to a specific dividend, which is separate from the dividends common stockholders receive and is also received before common stockholders? So in case of preference shares, there is a category or there is a type which is known as participating preference shares. In case of participating preference share, we need to remember one thing very clearly. Participating preference share is a type of share where the shareholder is allowed to receive or has a right to a specific dividend which is separate from the dividends common stockholders receive and are also received before the common stockholder. So that is known as participating preference shares. In case of participating preference share, this extra provision is allowed. Moving on to the next question. This is the 26th question of the evening. Which type of preference share enjoy the right to dividend even in the years in which company does not make profit? So if company is not making profit this year, but still you will be getting the same profit, may not be today, but yes, in near future you will be getting the profit for the previous year as well, where the company has not even made profit from its subsequent high profits. Then that type of share is known as what? So that is known as cumulative share. Just I have explained you a few minutes back that if company is making profit or company has issued a preference share at 10%, company is making profit less than 10, then company will be paying same profit only. But next year, when company has earned more profit, company will be paying the left out profit. So I would say, if I conclude, then I would say whether company has earned profit in second financial year or not, but I have received my entire promised dividend for that year as well, because I am a type of preference shareholder which is known as what? So which is known as cumulative preference share. Moving on to the next question. So the next question says India's first corporate bond issued by state-run companies traded on stock exchange is known as. So India's first corporate bond, which has been issued by whom? So it has been issued by the government-owned companies. It has been issued by the government-owned companies. If you remember, 22 companies disinvestment was announced, and at the time of the disinvestment, rather than issuing the shares of each company individually, they have come up with a fund which was called as exchange traded fund. An exchange traded fund is basically a provision where your investment can be diversified. So if you're purchasing an exchange traded fund, that means you are investing your investment in a diversified manner. So first diversified investment which was offered by government was known as Bharat Bond ETF, where you can invest your funds in the government bonds or in the government organization issued bonds, but rather investing all your investment in one bond. In this manner, you have just purchased a unit of ETF and your entire amount, that unit value, is diversified among different companies. That is known as exchange traded fund. Moving on to the next question. The next question says, which of the following debentures are attractive to investors who want to turn debt into equity if they think the company's stock will go up over the period of time? So you are holding a debenture, but in near future you can convert your debenture into equity because you are expecting that company's profits are going to increase in the near future. So that kind of situation is known as what? So it is known as convertible debenture, where the debentures, they can be converted into equity. So C option is going to be the correct answer. Convertible debentures can be converted into equity. Moving on to the next question. The next question says, what are the dangers that are posed by debentures? So if you are holding a debenture, what kind of risk you are going to witness while holding a debenture? Debenture is what? So it is a debt instrument. That means practically you have given loan to a company against which company has given you, I would say, a financial instrument, or I would say a document, an instrument which says that company will make the repayment in the near future. That is what we call it as debenture. But if the borrower do not pay back the amount, then you are going to witness what kind of risk? So you are going to witness credit risk for sure. Secondly, if you are investing in debenture, and you are expecting that your debenture is going to mature after 5 years, and after 5 years you will be receiving the principal as well as interest. Unfortunately, if the borrower do not pay back the amount at the time of maturity, and you were supposed to make repayments after 5 years to someone else, so you will be in a situation where you are liable to pay, but you have not received recovery, or you have not received back the funds where you have made the investment 5 years ago. So that kind of situation will be known as liquidity risk. If there is any revision in terms of regulatory norms, will those regulatory norms will affect the debenture holders? A regulatory risk, I would say, when a debenture is issued, the regulations which are going on at that time will be applicable. Once the regulations are revised, it won't be revised for the already issued debentures. So answer is going to be only 2. That is A and B type of risk is correct. Regulatory risk is not a correct example over here. Moving to the next question. This is going to be your 30th question. What does this question say? Is which of the following is the method of flotation in primary market? So what do you understand by the word flotation in primary market? Let's suppose you are owing a company and you want to raise the funds from the public. That means you will be issuing the shares, but before you issue the shares openly to the public, you need to take permission from SEBI, and once the SEBI approval is given, then a private limited company is allowed to issue the shares, and we call it as private limited company is going public. Now the moment you are allowed to go public, you have different methods with the help of which you can reach to the public in order to issue your shares. You can issue your shares through IPOs, initial public offerings. You can issue your shares through IPOs, that we call as initial public offering, and along with initial public offering, you can issue your shares through prospectus as well. So you can float your shares, offer through prospectus as well as eIPO. Offer through custodian, this is not correct. Custodian is one who is going to hold your shares. He is not going to issue the shares further. So C option is incorrect. Answer is going to be A and B, with the help of which you can float your shares and raise the funds from the public. Is it clear, everyone? Is it clear, everyone? Do reply in the comment section, please. Is it clear, everyone? Do reply in the comment section, please. Done, guys? Am I audible? May I have the answers in the comment section, please? Okay, fine. Just give me a second. By the time you go with the next question, just read out the next question. I'm attaching charger to my laptop by the time. So just read the question and give me the answer. What does it says? Okay, so the question is, what are the main functions of financial institution? So whenever we talk about financial institutions, what are their main functions? A short-term liability can be converted into long-term investment. Okay. It helps in conversion of risky investment into a risk-free investment. Okay. Act as a medium of convenience denomination. Okay. It facilitates the expansion of financial institutions and markets. So what are the main functions of financial institutions? So if I say short-term liabilities can be converted into long-term investment, that is true. It helps in converting the risky investment into risk-free investment, that is also true. It acts as a medium of convenience, that is also true. So answer is A, B, C and D. So I'll go with E option. These all are the services which are provided by different financial institutions which are operating in the country. Moving on to the 32nd question of the evening. Which among the following components of the financial system can provide an efficient flow of transfer of capital and be a part of that transaction? What will be your answer? Which among the following component of the financial system can provide an efficient flow of transfer of capital and be a part of that transaction? Which among the following component of financial system? We have to identify component of financial system. Second, can provide efficient flow of transfer of capital and be a part of that transaction. So on one side you are transferring, on one side you are talking about what? So on one side you are talking about transferring transfer of capital and as a part of that transaction. So you can transfer the capital with the help of financial assets as well as with the help of financial instruments. So these are the two among the three or among the four which can be the components which help us to transfer the capital as well as be the part of transactions. So financial instruments as well as financial assets is absolutely correct. Moving on to the next question, 33rd question of the evening. What does the question say? Which of the following is not an advantage of IPO? Increasing and diversifying equity base, rise in marketing and accounting costs that will mount with passage of time, ability to attract and hire better employees, creating multiple financing opportunities through equity, convertible debt, etc. Okay. See, whenever we go or we invest in IPO, whenever we are investing in IPO, we need to understand this point very carefully. That if you are investing in IPO, it increases and diversify the equity base. Obviously, it has an ability to attract and hire better employees as well as the management to oversee them through the liquidity participation, as well as it results in creating multiple financial opportunities. So this is true, this is true, this is true. Rise in marketing and accounting costs that will mount with passage of time? No, sir. This statement is irrelevant. This statement is irrelevant. Rise in marketing and accounting costs that will mount the passage of time is basically a disadvantage of IPO, not an advantage of IPO. So according to this, B is incorrect. Rest all are advantages, but this is the disadvantage of IPO. Moving on to the next question. This is going to be your 34th question. Which of the following statement is or are true with respect to capital adequacy ratio? We all know that capital adequacy ratio is also known as capital to risk weighted asset ratio. This ratio was first introduced by Basel norm. Specifically, it was introduced in Basel 1. Specifically, it was introduced in Basel 1. Secondly, if I talk about this particular norm, this particular norm, you need to understand one point very carefully. What does this point says? That sir, this particular norm has been introduced. This particular norm has been introduced keeping in mind to counter the credit risk. So it is also known as capital to risk weighted asset ratio. This is true. Indian scheduled banks, they are asked to maintain 9%. That is true. In Basel 1, Basel 2, Basel 3, it has been fixed at 8%. That is true. So answer is going to be D option. All of them are correct. Moving on to the 35th question of the evening. What does this question says? Which of the following statements are correct with respect to the risk weighted asset? Which of the following statement is correct with respect to the risk weighted asset? It is a bank's asset or off balance sheet exposures weighted according to risk. That is true. It is used to determine capital threshold risk factor. This is also true. The riskier the asset, higher will be RWA and greater capital is required. That is also true. So basically, risk weighted asset is what? So whenever we calculate the risk, on each and every, financial asset, of the bank or of a particular financial institution, then we call it as what? So in that particular scenario, we call it as what, sir? In that particular scenario, we call it as risk weighted asset. It is used to determine capital threshold risk factor. That is also true. The riskier the asset, the higher RWA and greater the amount of regulatory capital required. That is also correct. So answer is going to be 1, 2 and 3. All the three statements are correct with respect to RWA. Moving on to the next question, which is going to be your 36th question. Let's see what does this question says. Which of the following ensures that bank have an additional layer of usable capital that can be drawn down when losses are incurred? So bank has a useful layer which can be used to counter the losses. Useful layer, but they are asking you additional layer. First layer is capital adequacy ratio. Additional layer is capital conservation buffer. So additional layer is capital conservation buffer. Primary layer is capital adequacy ratio, which can be used to counter the losses in the near future as decided. Moving on to the next question. Which of the following NBFCs are not included under prompt corrective action? So all deposit taking NBFCs were not included. NBFCs not accepting public funds, all deposit taking NBFCs are included. First of all deposit taking NBFCs are included under PCA. They are undoubtedly included under PCA, but NBFCs which are not accepting public funds as well as housing finance companies, they are not included. So answer is going to be B and C. But as of 1st October 2024, a new statement has been came up by RBI, where RBI said that now government-owned NBFCs, which were earlier not included under the PCA, now they will also be included. And this inclusion will be done on the basis of 31st March 2024 data. It will be done on the basis of 31st March 2024 data. But base layer NBFCs will be ignored. But yes, above base layer, all the NBFCs which are owned by government will be included under the PCA as of 1st October 2024. Moving on to the next question, that is the 38th question of the evening. What does this question says? As per risk threshold 1, PCA or NBFC will be imposed if net non-performing asset is between. See, we know that PCA includes triggering points. So we have triggering point, that is risk threshold 1, risk threshold 2, then we have risk threshold 3. Parameters are tier 1 capital, second parameter is capital adequacy ratio, and third parameter is net NPA. So net NPA target is that it should be below 6%, but the moment NPA crosses a mark of 6%, it triggers and it comes under the risk category. And if it is in a range of 6 to 9%, that is risk threshold 1, 9 to 12%, it is risk threshold 2, and if it is greater than 12%, that is risk threshold 3. That is what? So that is risk threshold 3. Is it clear? I hope you must have heard about this. You must be getting what I have mentioned on the screen. May I have a reply in the comment section, please? May I have a reply in the comment section, please, so that I can move ahead quickly, everyone. Okay. Now let's move on to the next point. So the next point we have is, that is capital adequacy ratio. So it should be at least 15%. If it falls below 15%, then there is a triggering point. But here, if it is in a range of 12 to 15%, then it will be risk threshold category 1. If it is in a range of 9 to 12%, risk threshold 2. But if it is less than or below 9%, then what we will say, it will be risk threshold 3. What we will say it is risk threshold 3. If I talk about the tier 1 capital alone, so in case of tier 1 capital, limit is at least 10%. At least 10%. The moment tier 1 capital falls below 10%, that means 10% of RWA should be equals to tier 1 capital. If it falls below 10%, then trigger, or I would say trigger is done. There is a risk situation, and 8 to 10% is risk threshold 1. Then if it is below 8%, that is 6 to 8%, risk threshold 2. And if it is below 6%, then it is risk threshold 3. And depending upon the threshold condition, there are certain restrictions. Some are mandatory, some are discretionary restrictions which are introduced as per PCA. So PCA is basically an initiative which is taken by RBI in order to identify the financial institutes which are not doing well, and not only identifying, but along with that, there is an effort taken by RBI to correct them in order to avoid losses in the near future, or in order to avoid a situation where these financial institutes will be on the verge of insolvency. So this initiative has been taken. Now, according to net NPA threshold 1, net NPA threshold 1, answer is going to be what? That is A option, 6 to 9% is the correct answer. Moving to the next. Consider 39. Okay. 39th question. Consider the following statement about NARCL. So this is a company which was introduced. It has been incorporated in the Companies Act. That is true. Public sector banks, they will maintain bare minimum 51% ownership in NARCL. That is true. Why this ARC is set up? So this asset reconstruction company is set up with a sole motive. What is that motive? So that it will be resolving all the NPA cases of the banks of value greater than 500 crores. Value of bank greater than 500 crores, and the total value of NPA which is targeted at the time of setting up of NARCL was 5 lakh crores. So third statement is incorrect, because it is not going to target the loans of 100 crores. It started its journey by targeting the loans of 500 crores which have been turned into NPA. So on that particular basis, A option is the correct answer. Moving on to the next question, if I talk about the 40th question now, which of the following statement is correct with respect to the asset reconstruction company? So this company is regulated under SARFAESI Act 2002. So that is true. ARCs can take over only secured debts which have been classified as NPA. Obviously, if a loan is unsecured loan, it's impossible to initiate the recovery, and if it is not possible to recover your loan, then there is no way of implementing SARFAESI and initiating the process of recovery. So that is true. It is a specialized financial institutions that buy NPAs from banks and financial institutions so that they can clean up their balance sheet. That is also true. That is also true. So which of the following statement is correct? According to me, all of them are correct. A, B, C. Okay. We have an option. E option is correct. A, B, and C are the three options, or I would say they all are correct with respect to ARCs. Moving on to the 41st question of the evening. What does this question say? Which of the following is mandatory action? As I mentioned, there are two types of actions which are taken on a financial institute when they are included under the PCA category. One is mandatory, second is discretionary. Mandatory actions also depend on the category in which you are, that is, in which risk threshold category you are. So if you are in risk threshold 1, there will be restrictions on dividend distribution and remittance of profit, as well as shareholders will be asked to invest, or I would say will be asked to raise the capital, So according to this, A option is correct. But if this is risk threshold 2, then we have B option. In case of risk threshold 3, we have C option. So answer is going to be A option. That is absolutely correct. Moving on to the next question. That is, I guess it's 42nd question. So which of the following is mandatory action taken when risk threshold 2? So in case of risk threshold 2, these two are related to risk threshold 1. These are the mandatory actions under risk threshold 1. This is mandatory action under risk threshold 2. This is my answer. And this is the risk threshold 3 mandatory step which is taken. So these are the three things which you need to remember. This is absolutely clear. Moving on to the 43rd question. What does this question say? So this question says, which of the following is the discretionary? This is what I was talking about. There are some mandatory and other are discretionary. Restriction on dividend. So this is risk threshold 1, mandatory restriction. Restriction on branch expansion. So this is mandatory restriction in case of risk threshold 2. Restriction on directors' compensation. So this is again mandatory in case of risk threshold 3. But if a financial institute has been asked to decrease its lending as well as deposit, that means if a financial institute is asked to curb out your lending and deposits, this is not mandatory, rather it is a discretionary condition under PCA which we are talking about. Moving on to the next question, that is 44th question of the evening. Reserve Bank of India has introduced PCA in which year? So PCA was introduced by Reserve Bank of India in 2002. Then later on in 2017 it was revised, and after its latest revision in 2017 we have witnessed that 11 public sector banks, they were included under the category of PCA since 2017 or after 2017. So answer is going to be 2002. That is correct. Moving on to the 45th question. What does it say? Asset reconstruction companies must have minimum. Sir, asset reconstruction companies, they must have minimum net owned fund of 100 crores. Earlier this value was 2 crores, but later on it was revised and it was asked that the ARCs should be maintained. ARC should maintain 100 crores, of minimum net owned fund. So answer is going to be for E option. That is absolutely correct. Okay, chalo. Go through with this question, that is 46th question. And give me a second. Okay, have you gone through with the question? Just give me a second. Guys, just give me a second by the time you go through with the question and give me the answer. Okay, I hope you have gone through with the question. Sorry for the delay. So which of the following is a part of tier 1 capital used in capital adequacy ratio? Sir, audited revenue reserves is a part of tier 1 capital. That is true. Unaudited reserve, general loss reserves, they are not the part of tier 1, rather they are the part of tier 2 capitals. According to this, obviously A option is the correct answer. So answer to this particular question is going to be what? So it's going to be A option. Chalo. Moving on to the next question. Let's see what does the next question have for us. But before that, sir, what all things are included under tier 1 capital? I have mentioned it again. I'm mentioning it once again. It includes the equity capital, share capital, audited revenue reserves, and intangible assets. Remember that. These are the things which are included under tier 1 capital, which is the core capital. Now, NARCL was set up, we know that. And NARCL was basically responsible to purchase the bank's NPAs and then initiate the process of recovery. But at the time of setting up of NARCL, it was very clearly mentioned. It was very clearly mentioned that NARCL will purchase the NPS from the bank, and at the time of purchase, NARCL will pay 15% of the purchase value in the form of cash, and rest 85% will be paid in the form of government securities, and these government securities are going to be matured, or they are going to be encashed after 5 years. So answer to this particular question is what? That is A option, 15% and 85% is the correct answer. Moving on to the next question. The next question says, when was the Asset Reconstruction Company Limited set up? So Asset Reconstruction Company Limited was set up in the same year when SARFAESI Act was introduced, and it was set up in 2002 itself. That is absolutely correct answer. Moving on to the next. Which of the following is correct about capital adequacy ratio? So it is the average ratio of bank's capital? No. It is the ratio of bank's capital to its risk? That is true. It is bank's inability to observe the possible losses? Inability, no. It puts depositor money at loss? No, sir. So answer is, it is the ratio of bank's capital to its risk, so that the capital is in a position to observe or to handle the risk which bank may witness in the near future. Moving on to the next question, that is the 50th question. What are the two broad categories in which bad bank divides the asset? So bad bank divides the asset into which two categories? This is an important question. So bad bank divides the asset into two categories, and these two categories are, first one, non-performing and risky liabilities, non-performing and risky liabilities, and second one is healthy liabilities. So non-performing and risky liabilities is one and healthy liabilities is one. So in total there are two categories in which bad bank divides the assets of the bank. Moving on to the 51st question, which of the following is correct about capital adequacy ratio? Sorry, it's a repetition. It is a repetition, na? Yes, it is a repetition. So moving on to the next question, I'll number it same, 51. So as per the revised framework of PCA, what are the key areas for monitoring prompt corrective action framework? So in case of prompt corrective action framework, there has been revision done recently. Earlier, profitability was also a part which was used as a parameter to judge that whether the financial conditions of the bank is good or not. But now profitability has been ignored. Yes, capital as well as asset quality are the two measures which are used in order to find out the financial situation, the financial status of a particular financial institution. So D option is correct. A and B are correct. Moving on to the 52nd question of the evening. Capital adequacy ratio as per Basel III should be 8%, and as per RBI it should be what, sir? It should be 9%. This we have discussed a number of times. I am sure pretty clear to everyone. Moving on to the 53rd question. Which of the following risk factor must be taken into consideration to calculate capital adequacy risk? So when we calculate the capital adequacy ratio in starting as per Basel I, so according to Basel I, while calculating capital adequacy ratio, only credit risk was included. Then as per Basel II said we should include not only credit risk but also market risk and operational risk. And finally, now it is a situation when capital adequacy ratio is calculated. While calculating the capital adequacy ratio, we consider credit risk, operational risk as well as market risk. Credit risk, operational risk as well as market risk. So E option is the correct answer. Moving on to the next question, that is the 54th question. Prompt corrective action is an important step taken by government with respect to which of the following? Insolvency plan for financial institutions, okay. Bailing in default corporation, okay. Trigger point to take corrective action on weak and troubled banks, capital infusion in public sector banks, and plan on merging the public sector banks. What will be your answer? The question says कि भैया PCA क्यों लाया गया? Why PCA was introduced? Sir, it was introduced as an insolvency plan. No, sir, it was introduced to avoid insolvency. Bailing in default corporation? No, sir. Trigger point to take corrective action? Yes, sir. We need to introduce a trigger point where government can take, RBI can take the corrective action beforehand in order to avoid a situation where the bank or the financial institution will be on the verge to be declared as insolvent. So C option is the correct answer. Moving on to the next question, that is the 55th question of the evening. Reserve Bank of India introduced prompt corrective action framework for large non-banking financial companies. The framework will come into effect. Okay. Reserve Bank of India has introduced PCA framework for large NBFCs. Now the question is, it was introduced for large NBFCs and it was implemented from which date? What will be the answer? What will be the answer? So it was implemented from 1st of October 2022, and now from 1st of October 2024, government owned NBFCs are also included under the PCA, under the framework, under the PCA framework. That would be better. Moving on to the next question, 56th question. Reserve Bank of India has decided to put in place a prompt corrective action framework for troubled NBFCs to restore their financial health. Regarding this, which all statements are correct? PCA framework for NBFCs come into effect from 1st of October 2022 based on their financial position 31st March 2022. That is correct. For government owned NBFCs, 1st of October 2024 based on their position on 31st March 2024. The framework will apply to all deposit taking NBFCs excluding government. That was true, but now it has included government companies as well, except those government NBFCs which are included in the base layer. Those government NBFCs which are included in the base layer. The central bank will track 3 indicators: capital to risk weighted ratio, Tier 1 and net NPA. Yes, sir, we have just discussed. Even I have given you the triggering points few minutes back. In the case of core investment companies, RBI will track adjusted net worth, leverage ratio and net NPA. That is also true. So answer is going to be all of the above is correct with respect to the PCA framework for NBFCs. Moving on to the next question, that is 56th question. Which of the following statement is or are not correct regarding the prompt corrective action, which is a qualitative tool introduced by Reserve Bank of India? It was introduced in 2002 during the period of Bimal Jawaharlal. That is true. There are 5 parameters for evaluation. No, sir. Earlier, there were 4 parameters for evaluation. This is wrong. PCA framework is applicable to all scheduled commercial banks, small finance bank, payment banks and NBFCs. What will be the answer? This is a good question. Anyone out there can give me the answer for this? Anyone out there can give me the answer for this? So the answer to this particular question is correct. So answer is only 2 and 3 are correct. Sorry, what we have to find out? Not correct. One second. We have to find out not correct. So PCA framework is applicable to all the scheduled banks? No, sir. It is not applicable on all, such as it is not applicable on payment banks yet. So third option is incorrect. Earlier NBFC was also the case. So that was correct, but now NBFC has been excluded. So answer is going to be incorrect are only 2 and 3 and correct is only 1. So answer is going to be first statement is correct. Rest 2 statements are incorrect. Moving on to the next question, that is 57th question. The term private placement is related to. So the term private placement is related to monetary policy? No. Foreign policy? No. Money market? No. It is related to what? So it is related to capital market, which basically means a company when it issues its shares to the investors, not openly to the public but to the specific investor, that is known as what? It is known as private placement. D option is correct in that case. Moving on to the next question, that is the 58th question. What does it say? What does contango mean in financial market? This is an important term. So contango basically means a scenario where the price of commodity is higher in future market than the spot market. That is basically termed as what? Contango. That is basically termed as contango. May I have the answer in the comment section, please? So the answer to this particular question is a scenario where the price of commodity is higher in future market than the spot market is known as contango. That is correct. Moving on to the next question. This is going to be your 59th question. Which concept aims to protect banking sector from periods of excess aggregate credit growth that have often been associated with build-up of system-wide risk? So whenever we talk about system-wide risk, which concept aims to protect banking sector from period of excess aggregate credit growth? So whenever there will be excess aggregate credit growth, then you need access of capital reserves which can be maintained when bank is in a normal condition and earning pretty well. That is known as counter cyclical capital buffer, where bank is asked by RBI to maintain a reserve of 0 to 2.5%. 0 to 2.5%. Moving on to the next question. The next question says, that is the 60th question of the evening. internal capital adequacy assessment process component was introduced in which Basel norm? Sir, internal capital assessment or internal capital adequacy assessment process was introduced under which? So it was introduced under Basel 2. I would say two things over here. One is internal capital adequacy assessment process. It is one of the important pillar, or it is one of the important component under the second pillar of Basel 2 norm, that is known as supervisory review, which included ICAAP. Got it, guys? Clear? Moving on to the next question. As per Basel 1, private sector debt is included in which of the following risk category? As per Basel 1 norm, private sector debt is included in which of the following risk category? Private debt means 100% risk. If it means 100% risk, so it will be included in E category. So in 100% risk, what all are included? So it include private sector debt as per Basel 1, non-OECD bank debt with maturity over 1 year, real estate, loan against plant and equipments, capital instruments issued at other banks, they all will be included under the category of 100% risk as of Basel 1. Moving to the next question. The 50% risk category of banks classification by Basel 1 norms consists of, so 50% consists of only one, that is residential mortgage. Residential mortgage is a part of 50%. I hope I'm correct. 50% residential mortgage. Yes, A option, that is correct. Moving on to the next, which of the following Basel norm does not takes into account market and operational risk? So market and operational risk was not taken into account in Basel 1. Only and only credit risk was taken into account in Basel 1. So answer is going to be A option, that is correct. Moving on to the next question. Basel 3 norms was created. So if I talk about Basel 3 norms, so for the reform of capital adequacy and liquidity standard for the banks, okay, to lower down the NP of public sector banks, to establish capital requirement for market risk and operational risk, to deal with central banks across country. Okay, what I believe is in case of Basel 3, what changes have been introduced? Or in case of Basel 3, the major change which has been introduced is related to leverage ratio, liquidity coverage ratio, as well as net stable funding ratio. So Basel 3 was basically introduced for the reforms of capital adequacy and liquidity standard. So answer is going to be A option. That should be the correct answer. Moving on to the next question, that is going to be 68th question. Which of the following parameter is used by foundation internal ratings based approach for assessment under Basel norms? This is a good question. So which of the following parameter is used by foundation internal rating based approach? So foundation internal rating based approach works upon probability of default. It works upon what? So it works upon probability of default, which basically means foundation internal rating based approach, banks use their own assessment of parameters like probability of default, while the assessment method of other parameters, mainly risk components such as loss given default and exposure at default, are determined. So answer is going to be A option. Moving on to the next question. Which of the following is the component of supervisory review, that is pillar 2 of Basel 2? Internal capital adequacy assessment, true. Supervisory review and evaluation process, true. Capital above the minimum level. Capital above the minimum level or anything related to capital has been discussed. Then my answer would be, so supervisory review was added because of the necessity of efficient supervision and lack which was witnessed in case of Basel 1. So pertaining to the assessment of the bank's internal adequacy, this has been introduced, which include internal capital adequacy assessment. It includes supervisory review and evaluation process, as well as it includes the capital above minimum level. So answer is going to be E option, that is A, B and C. Moving on to the 69th question of the evening. Which of the following statement is or are correct with respect to Basel 3? Banks are required to hold leverage ratio more than 3%, true. It introduces requirements on liquid asset holdings and funding stability, thereby seeking to mitigate the risk of a run on bank. Risk of a run on bank, that is true. It raised the minimum capital requirement, that is also true. It raised the minimum capital requirement from 2% in Basel II to 4.5%. Yes, common equity is mentioned, that is correct. So answer is going to be D option. 1, 2 and 3 are correct. All the factors are clearly mentioned. Guys, last question from my side, the 70th question of the evening. Actually, I have more than 100 questions for you, but I have a next session at 10 p.m. So under Basel III, as per RBI norms, the minimum capital adequacy ratio required to be maintained according to Basel norm, this is 8%. According to RBI, this is 9%. Along with this, I have ample of more questions which you can follow. I will be sharing this PDF on my Telegram channel. You can follow these questions, but along with these questions, I have few more important things for you. What I have is, I have few descriptive questions which I would like to discuss before I conclude the session. But surely download this PDF, guys, and try to attempt all the left out questions which will help you to give more insights related to your finance section. So let's quickly jump on the descriptive part. So I have few questions for you. The first question which I have framed for you is, financial institutions, they play a important role in every economy. Discuss their importance by highlighting the key functions performed by them. So I'm talking about financial institutions, they play an important role in economy. Discuss the importance by highlighting the key functions. So this is the question along with the sample answer. Then we have the Indian banking sector is rapidly evolving and it is expected to further evolve with rapidly changing technology. In this context, highlight the changes and transformation that have been witnessed in the banking industry. So all the changes which have been done in the banking, I would say, industry has been mentioned. Then the next question is, what do you mean by PCA? Discuss the context of PCA framework introduced by RBI on NBFC. This is one of the question which has a high potential that it can be asked in the examination. Don't forget to cover this question. What do you mean by monetary policy? How effective the RBI monetary policy transmission? Transmission means if repo rate is decreased, how well it is transmitted onto the bank lending rate so that overall inflation rates can be controlled. So that transmission part has need to be discussed. I have given the sample answer. Then write a short note on monetary policy committee. I'm pretty sure you can do it. What do you mean by term standing deposit facility? This is important, which can be asked in the exam. Then I have, what are the different initiatives which are taken by RBI in order to promote financial inclusion? So I have all the important parts from that as well. So do download this PDF from my Telegram channel. Read the descriptive answers before you go for the examination. If you are aiming for 2025, then use the code MADHAV in order to enroll yourself in Lakshya batch so that you can get the maximum discount. So this is my Telegram channel, guys. I'm in bit rush. Obviously, you must be feeling that because I have a next session at 10 p.m. So I think all the things which we have discussed today were crystal clear. 30 questions I have given you as a homework. Along with that, I have 8 questions in the descriptive format along with their sample answers in this PDF, which you can follow for sure. Thank you so much, guys. We'll catch you in the next session. Good luck. God bless you all and good luck for your upcoming phase 2 examination. Bye-bye.